Hey everyone, Longacres Finance here, and today I want to show you how I built a quality dividend stock portfolio. I will walk you through the process I used to select the stocks for the portfolio. Then I will show you the actual portfolio, which went live on September 1st, so stay tuned. Before we jump in here, a little disclaimer. This video is for informational purposes only and should not be construed as investment advice. Also, if you're new to my channel, please subscribe to get more content like this. Okay, enough fluff, let's get going. I will be using Schwab's stock screener to get my data. The data was pulled on August 26th. You do need to have a brokerage account with Schwab to use their screener. If you use a different brokerage, they may have their own screeners. There are 9 metrics I want to use to develop my portfolio. And they are the market cap, payout ratio, S&P earnings and dividend rating, Morningstar economic moat, Morningstar Stewardship, Schwab equity rating, volatility rating, the 5-year dividend growth rate, the 5-year revenue growth rate, and the 5-year earnings per share growth rate. If you are unfamiliar with any of these metrics, don't worry, I will explain what they are and how to interpret them shortly. Now, instead of simply thinking of my own thresholds for each of these metrics, I want to do some simple exploratory data analysis to see if I can identify any trends between these 9 metrics and historical total returns. Here's how I will do that. I set up my Schwab screener to give me a list of stocks that meet the following 3 criteria: a market cap of at least $2 billion, an annual dividend of at least 1 penny, and only stocks that trade on the New York Stock Exchange or NASDAQ. The reason I chose these filters was because I want to focus on stocks that pay a dividend, I want to exclude very small companies, and I want to use stocks that are easily accessible on popular brokerages. The screener returned 942 stocks. I added my 9 metrics to the screener, and also the 5-year total return and the 3-year total return. Next, I will look at each metric individually and see if there is any correlation between that metric and the past 5- and 3-year total returns. It would be too cumbersome to show you the entire process, so I will show you the end result here, and I'll go through each metric one at a time. Let's start with the market cap, which basically shows you how large a company is. The market cap is simply the current share price multiplied by the number of shares outstanding. I divided the stocks in my universe into 3 subgroups based on the trends I observed. The subgroups are stocks with a market cap greater than or equal to $50 billion, stocks with a market cap greater than or equal to $10 billion, but less than $50 billion, and stocks with a market cap smaller than $10 billion. As you can see in the table on your screen, stocks with a market cap of $50 billion or more on average, significantly outperform stocks with a smaller market cap. Stocks with a market cap of $10 billion or more, on average, perform slightly better than the universe average, and stocks with a market cap below $10 billion, on average, underperform their larger counterparts. Based on this trend, my final screener should favor stocks with a large market cap. Moving on to payout ratio. A payout ratio shows you how well current earnings cover dividend payments. To compute a payout ratio, you take the annual dividend and divide it by the annual earnings per share. Let's see if there was any correlation between payout ratios and total returns. After reviewing the data, I divided the payout ratio into 4 subgroups. Payout ratios below 40%, below 70%, below 100%, and greater than 100%. As you can see in the table on your screen, stocks with a smaller payout ratio on average outperform stocks with larger payout ratios. Specifically, stocks with payout ratios below 40% on average significantly outperform the universe average. Stocks with payout ratios below 70% on average achieved about the same total returns as the universe average. And stocks with a payout ratio below 100% on average outperformed stocks with a payout ratio above 100%, but both came in significantly below the universe average. Based on this trend, I will want my final screener to favor stocks with a smaller payout ratio. Let's move on to the S&P earnings and dividend rating. This rating, provided by S&P Global, rates the quality of a stock's historical earnings and dividend growth over the prior 10 years. A stock is assigned a letter grade, with A+ being the highest. Let's see if there was any correlation between the ratings and total returns. After analyzing my data, I broke down the ratings into 4 subgroups: A+, A, A-, and B+ and lower. As you can see, higher rated stocks on average outperform the universe average. A+, A, and A- are considered above average ratings by S&P. And interestingly enough, they all outperform lower rated stocks. Based on this trend, my final screener should favor higher rated stocks. Moving on to Morningstar's economic moat, which evaluates a stock's competitive advantage. A stock can either have a wide moat or a narrow moat. Think of it as having an actual moat around a castle. Obviously, having a wider moat is better than having a narrow moat. Unfortunately, Morningstar doesn't provide this metric for all stocks, so I worked with the data that was available. As you can see in the table, stocks with a wide moat on average outperform the universe, while stocks with narrow moats on average were right in line with the universe average. Stocks that were missing this metric on average underperformed the universe average. Based on this trend, I will want my final screener to favor stocks with a wide moat. Moving on to Morningstar's Stewardship Rating, that judges the management team of companies. A company can receive any of 3 ratings: exemplary, standard, and poor. Similar to the economic moat, Morningstar doesn't offer these ratings for all companies. So once again, I worked with the data that was available. As you can see in the table, stocks with exemplary management teams, as rated by Morningstar, on average outperformed the universe average. Stocks with standard management teams, on average, did a little worse than the universe average. Stocks with poor management teams, on average, achieved pretty terrible returns. And stocks that were missing this metric, on average, performed in line with the universe average. Based on this trend, I will want my final screener to favor stocks with exemplary management teams. Moving on to Schwab's equity rating, Volatility Outlook, that rates stocks on their historical volatility compared to their peers. A stock can have one of the following ratings: low, medium, or high. As you can see in the table, stocks with a low or medium volatility rating on average outperform the universe average. Stocks with a high volatility rating on average significantly underperform the universe average. Some stocks were missing this rating, and on average they performed poorer than the universe average. Based on this trend, I will want my final screener to favor stocks with a low or medium volatility rating. Moving on to the 5-year dividend growth rate, which shows the annualized growth rate of a stock's dividend over the last 5 years. As you can see in the table, I broke down the dividend growth rate into 5 subgroups: dividend growth greater than 13%, greater than 8%, greater than 5%, greater than 0%, and negative growth rates. The trend, as expected, shows that stocks with higher dividend growth rates tended to have higher total returns. Based on this trend, I will want my final screener to favor stocks with higher 5-year dividend growth rates. Moving on to the 5-year revenue growth rate, that shows the annualized growth rate of a stock's revenue over the last 5 years. As you can see in the table, I broke down the revenue growth rate into 4 subgroups: revenue growth greater than 7%, greater than 5%, greater than 0%, and negative revenue growth. The trend here is similar to what we saw with the dividend growth rate. Stocks with higher revenue growth tend to have higher total returns. Based on this trend, I will want my final screener to favor stocks with high 5-year revenue growth rates. Moving on to the 5-year earnings per share growth rate, which, as opposed to revenue growth that shows top-line growth, shows the bottom-line growth for a stock. The reason I decided to look at both is because you want top-line growth to flow through to the bottom-line growth, and by looking at both, we can weed out the stocks where that isn't the case. As you can see in the table, I divided earnings per share growth into 5 subgroups: earnings per share growth greater than 18%, greater than 9%, greater than 5%, greater than 0%, and negative growth. Similar to dividend and revenue growth, stocks with higher earnings per share growth tended to have higher total returns. Based on this trend, I will want my final screener to favor stocks with higher earnings per share growth. Now that we've gone through all 9 metrics and identified some trends, what do we do with all this information? Well, let's combine all 9 metrics into one screener. I did this using Excel and conditional formatting. Using if statements, I assigned a score to each stock where it received 1 point for each condition it met. My first filter had pretty strict conditions: a market cap of 50 billion or more, a payout ratio below 40%, a wide economic moat, an exemplary stewardship rating, an A+ S&P quality rating, a low volatility rating, a 5-year dividend growth rate greater or equal to 13%, a 5-year revenue growth rate greater or equal to 7%, and a 5-year earnings per share growth rate greater or equal to 18%. This first filter resulted in 0 stocks meeting all 9 conditions. The best result was 7 conditions met by only 8 stocks. So obviously I will need to loosen up my conditions to have a good number of stocks meet all 9 conditions. I started slowly easing all conditions one at a time and reviewing the count and the average return of the stocks for each value of conditions met for each iteration. After many iterations, I got to a point where enough stocks, at least 20, met all 9 conditions, and lowering any of the conditions further yielded no benefit to the average historical return of the stocks that met all 9 conditions. Here are the final metrics in my filter: a market cap greater than or equal to $10 billion, a payout ratio less than 70%, a wide economic moat, an exemplary or standard stewardship rating, an S&P quality rank of A- or better, a low or medium volatility rating, and a 5-year dividend, revenue, or earnings per share growth rate greater than or equal to 5%. 25 stocks met all 9 conditions. But before I show you the stocks, let me first show you the average historical returns for each number of conditions met. As you can see in the table, stocks that met all 9 conditions, on average, significantly outperformed the universe average. Historical returns for stocks that met 7 or 8 conditions look nice as well. However, those averages are inflated by a few stocks that achieved exceptional historical returns. Here are the ticker symbols for all 25 stocks that met all 9 conditions, listed by sector. As you can see, the list is skewed towards the top 3 sectors. Now that I have my list of stocks, let's move on to designing the portfolio. I want to establish rules for this portfolio that will automate the process and remove me from having to make any decisions. One of the worst things an investor can do is make emotional decisions with their investments. Here are the rules. The portfolio will have a minimum of 20 and a maximum of 40 holdings. If the screener returns less than 20 stocks that meet all 9 conditions, the closest stock with 8 conditions will be added. The dividend, revenue, or earnings per share growth metrics will be used to decide. If the screener returns more than 40 stocks that meet all 9 conditions, the stocks with the lowest dividend, revenue, or earnings per share growth rate will be excluded. The portfolio will be equally allocated to all included stocks, to the best of my ability, and with incurring the lowest amount of tax liability. The screener will be ran every quarter, and the portfolio positions will be adjusted on the first day of each quarter. The benchmark for the portfolio will be the S&P total return. The reason I chose the S&P total return is if I didn't put my money in this portfolio, it would probably be sitting in the S&P. I will be doing a live test of this portfolio using M1 Finance because they made the most sense versus other brokerages for this specific portfolio with limited capital. So I actually started this portfolio on September 1st, 2020 with $100. You can see a screenshot from M1 Finance here. I will be adding $10 to this portfolio each week, and I will be making weekly or monthly videos to update you on the results. The goal is to outperform the S&P total return over the long term. That's it. Thanks for watching. Please subscribe so you can be notified of any future videos.